first day of the official Santa Claus rally. It typically is the last 5 trading days of December, so this week, the final week of the year, and then the first 2 trading days of the new year. According to CFRA research, since 1975, the S&P 500 has been positive in that stretch 3/4 of the time. But now we have the wildly spreading, and I mean wildly spreading Omicron variant playing Grinch. Could it derail that famed traditional Santa Claus rally? And then what? Let's get straight to the floor show and say hello to Kenny Polcari and Tom Hayes. Good to see both of you. Kenny, Merry Christmas, happy everything. Let me begin there. Okay, let's say we get the Santa Claus rally. Do we or do we not? But what happens more importantly in the new year? As January goes, so goes the year.
Well, listen, Lauren, it's great to be here with you, and Merry Christmas to you. Look, it appears as if today we're getting this Santa Claus rally. People should understand that, you know, in this last week, there's a lot of players that are away from their desks, so volumes are lower, which makes for these exaggerated moves. That being said, the market is the market, and it's moving higher, and it is what it is. So call this a Santa Claus rally. We'll see how the rest of the week goes. But again, what I'll tell you is get ready for next year, because once we wipe the slate clean in January, everything gets reset to zero, and then asset managers are going to have to perform in a new year that's going to see lots of challenges from the Fed, from economic policy, from interest rates, and from inflation, where I actually think there's going to be a fair amount of turbulence in the first 6 months of the year.
I want to get into that turbulence and the themes that you see for 2022. I think most people would agree, Kenny. But, Tom, I want you to comment on this, because I think this is part of the euphoria that we're seeing right now, even though, as you note, Kenny, volume is low. JP Morgan, we do not expect Omicron to impact the growth outlook significantly. It will accelerate the end of the pandemic. Is that one reason why stocks are higher, Tom? And would you agree with that?
I think that is one reason, Lauren. And, you know, we mentioned last week on the show there would be no Grinch and Santa would be coming to town. So far, we're seeing that. The other thing that I think, well, you see the South African cases, they're down 85% in the last 15 days. So people are hopeful that collapse will follow in other markets where we're seeing high Omicron, like the U.S. And managers were underweight. So if you look at the National Association of Active Investment Managers, going into Christmas, they were at just 52% equity exposure. They've moved up to 67%, but they're still underweight. So even if you take a breather in the next day or so after 4 days up, I think over the next week to 2 weeks, this can push higher and grind higher as managers are underweight. And in the context, you mentioned the retail sales data up 8.5%. By the way, up 10.7% from the pre-pandemic numbers in 2019 as well. And earnings growth for next year is going to be over 9%. So it's a very constructive environment in the short term, but volatility is going to pick up quite a bit in 2022.
Absolutely. And Kenny, you brought up inflation as a headwind earlier. I mean, yeah, the consumer's strong for now. No one expects inflation to subside, at least not in the first half of next year. How big of a problem is inflation and also the Fed's response to it?
Well, so here's what I think. At Chris's point that asset managers are underweight, I think you could argue that they're underweight because they are concerned exactly about this next point, right? Inflation, the pace of inflation, the pace at which the Fed is going to react. Are they going to be basis point moves, or are they going to be half-point basis point moves? And that, I think, is still up in the air, right? Because there's conversations going both ways. And while the market is prepared for 325 basis point moves, it's going to be very, very surprised if we get a 50 basis point move sooner than expected. And that could explain why some asset managers may be being more cautious, because they're waiting for that move to happen. Now, look, we know that could not happen. It could just keep going the other way, and then they're going to play catch-up, right? They're going to have to run to play catch-up. My sense is, though, they are going to see that turbulence, and they are going to see pressure in the market in the first 6 months.
Yeah. No, I mean, and look, we're all looking at the markets this year. The broader market is up 27%, if my eyes do not fail me. I mean, it's going to be hard to repeat that, especially when you look, Tom, at some of the big tech names that are such a big part of the overall market. Google is up 70% this year, right? Tesla is up, what, 50%? Facebook, Apple, they're all up. I mean, gangbusters. Does that just continue, or are we going to have new trends to talk about?
I think new trends, Lauren. You know, there's the old song, Don't Fear the Reaper by Blue Oyster Cult. Everyone's worried about rate rises, but history tells us since 1955, the first 12 months after the first rate hike, which would be March or May, the S&P is up on average 7.7%. That said, I think we're going to see a rotation in a rising rate environment. Cyclicals tend to outperform. So it favors values, cyclicals, small cap. We like industrials. Industrials are expected to grow earnings 36% next year relative to the S&P 500 going to grow earnings at 9%. And in that context, we like Raytheon's trading at 16.5%. And we like GE. We think the sum of the parts is greater than the whole in the three-part breakup that's going to take place over the next 12 to 24 months.
Tom, is that because of the bipartisan infrastructure bill, or do you like industrials for other reasons?
I like industrials just generally because the supply chain issues, aviation is going to come back in a major way when you look at Raytheon, when you look at Boeing. So there's a lot of pent-up demand. There are a lot of headwinds with the supply chain this year that will be overcome, and I think the pent-up demand is going to be phenomenal for 2022. And money tends to flow into those areas, the cyclical areas, when rates are rising. When rates are low, people look for the long-duration earnings like tech. When rates start to go up, they want current earnings today like industrials.
All right, Kenny, I'm going to let you tie this up in a bow for us. This is my question for you. You know, we're talking about infrastructure. The social infrastructure plan, the Build Back Better, is stalled, maybe dead. But, you know, if we don't have any more stimulus or money going to consumers, and then you don't have that consumer spending a lot next year because they have less money and inflation is super hot, what happens?
Well, so then I think that's part of that economic story about we're going to see a slowdown in the economy. Certainly not going to go negative, but it can't keep up at the pace that we've had. And part of that pace has been fueled exactly by all that extra money that the Fed has not only sent out to people, but have in their own been stimulating the system, which is why, once again, I think we're in for a little tough time. And I agree with him. You should be looking at industrials. You should be looking at energy. You should be looking at financials. But let's not think that we're going to have a repeat of the last 3 years where we've seen double-digit gains in the 20s, and the NASDAQ was up 40% last year, right? It's up another 20% this year. I think we borrowed on future performance. So I'm actually looking for the market to return to more of a normal, if you can even define it as that, as a 10 to 12% return. But I agree with Tom. I'm in his camp.
Yeah.
Well, we're selfish. I like those big gains. Kenny, Tom, thanks for the time. Have a good day, guys.
Thanks, Lauren.
Bye-bye.
And a lot of younger investors don't, that's all they're accustomed